predicted, the US Federal Reserve did raise interest rates by 0.25%. That makes it the third increase this year. We'll have more on that in a moment, but let's take a quick look at how markets are reacting. And Europe's share markets are taking a tumble. That's in part due to the Fed's latest move. But investors are also rattled by Italian media reports about the long-awaited budget from the populist government. It was due today, but may be delayed. London's FTSE is bucking the downward trend, though. Well, Asian markets were also rattled by the rate hike, which will make borrowing more expensive and slow economic activity. Investors in China also sold off after new data showed industrial profit growth is continuing to slow. US futures are pointing to a lower open on Wall Street. Stocks finished deep in the red at the end of Wednesday's session, and that's despite Fed officials upping their outlook for US economic growth this year. And oil prices are still on the rise, with West Texas crude up 1%. The rally is being driven by the prospect of a shortfall in global supply once US sanctions against major oil exporter Iran come into effect in just 5 weeks' time. Well, now back to the US Federal Reserve's decision, and Jameel Ahmad joins me now from Limassol in Cyprus. He's head of currency strategy and markets research at online trading firm FXTM. Good to have you back with us. So the Fed did raise rates as expected, and we've just got figures coming in basically confirming that the Q2 growth in the US was at 4.2%. So this basically just justifies the Fed's decision, doesn't it?
Thank you very much. There's not really any surprises after the Federal Reserve decision yesterday, because everybody already expected the Federal Reserve to raise US interest rates this month, and that's exactly what happened. We had a near 100% probability at one point of an interest rate rise, and the key takeaways really from the decision is that the Federal Reserve are upbeat on US economic growth. They expect growth to remain above 3% for some time. They also expect another interest rate rise in December, which supports the dollar, and 3 interest rate rises in 2019. But here's the interesting point. In 2020, only at the moment expected 1 US interest rate rise, which does mean that after 4 interest rate increases overall in 2018, if December goes ahead, that we can expect a less aggressive Federal Reserve when it comes to US monetary policy heading into 2019 and 2020.
And what about emerging economies? Are those countries expected to follow the US's lead?
Well, some economies, yes, as we've seen a lot of expectations on central banks like Indonesia and also Turkey, but even more so like the India as well, to raise interest rates to protect currency weakness and to destabilize inflationary pressures. But the more positive news is that despite the US interest rate rise from yesterday, most emerging market currencies throughout the APAC region actually traded higher against the US dollar today. We only saw weakness in the Indian rupee and the Chinese yuan. And if the Federal Reserve do maintain a slower pace of US interest rate rises after 2018, this should actually stabilize emerging market currency weakness, at least when it comes to the US interest rate outlook.
Okay, Jameel Ahmad, thank you again for your thoughts.